The difference between elite traders, noobs, and just lucky guys is really in the way they trade. And while most traders use directional strategies, the professional guys, the elite traders, really use market neutral strategies. Hi guys, I'm Logical Orange, and in this video we are going to talk about 5 market neutral strategies that will really open your eyes to new trading horizons. Before we start, I just want to take a moment and talk about risk. So there are two main types of risk. The specific risk, which is the risk that is tied to an asset. For example, let's take into the crypto world, let's take Cardano. Cardano has its own specific risk, which at the moment is tied to the deployment of the smart contracts and of course the announcements they make. In the stock world, I can give you an example for Tesla. So Tesla has, of course, its specific risk as any other asset in the world. And in the case of Tesla, it is tied to the development, the investments the company makes into certain assets, like let's say, for example, Bitcoin, and other aspects. A lot of aspects come into the specific risks. So if we want to handle the specific risk, the only way we can do it is by diversifying our portfolio. The second type of risk is the systematic risk. This is the market risk. This is the exposure we gain into the market when we buy into an asset. A way to handle this is to hedge against your initial position. The way the professional traders do it is to open longs in a certain asset that they are certain that it will gain value, and open short on an asset that they think, open a short in an asset that they think that the value will drop. Of course, the amounts would be equal, and in general, the idea is you will buy your good ideas and you will sell your worst. Of course, you will be able to benefit from your short difference if your sellable asset reaches the lower target that you predicted, and of course rebuy. All this protected with the long on another coin. Of course, the correlation between the two coins must be there in order to allow us to create a good hedge. So for the systematic risk, the solution is hedging. Now, how can we use this into the crypto world? Now, there are 2 or 3 solutions for this. The first one would be to play with the instruments that are available on the exchanges right now. For example, on Binance, you have several types of futures. You have perpetual futures, you have quarterly futures, and you have coin M futures. These are 3 different instruments that you can play on. Eventually, you can even hedge on them. So let's say, for example, that you want to open a long on BTC USDT perpetual, but you want to protect your position because you are not exactly sure on how high it will get, and it might be the price might go down. So you can open a short position on, let's say, coin M, of course with a coin collateral, and on this short position you will be profitable because the price will drop. Now you will have a lower target where you will take profit, and your initial position will be a negative. However, being that the 2 positions are equal, you will be protected in this manner, because you will gain on the short and you will lose on the long. However, you will continue your short position with another position, another entry, which would be a long entry. And like this, you can create a continuous circuit of trading that will be continuously protected. The second type of strategy that we can use in order to protect ourselves against systematic risk is market making. Now, market making sounds complicated, and it can be if it is used at a large scale, and it is the preferred method of creating profit for institutionals. It involves selling, buying, so shorting and selling and buying at the same time, much like hedging. however at a faster pace, sometimes at a very fast pace which is called high frequency trading and which is handled by bots. So when I mean bots, I don't mean simple bots like we have available on the market. I mean really AI bots that can spot spread differences on different exchanges, because usually they use arbitrage schemes in between, they complexify the strategy by using all the resources available to them. For example, I have a client that has placed his market making servers the closest possible to Binance's servers, so they can have the fastest response time when executing orders at a very high frequency. So market making is the second option. Can you use it at let's say normal trader level? Yes, you can. There are some software available, some softwares available on the market. However, the results that I have tested are not really good, and I really think that this part, the market making, is sadly reserved for the professionals that have the resources to create the software needed in order to execute the orders at the fast pace, detect the spread differences, and really profit. Okay, so that didn't help much. Market making, how does that help you? Well, it helps you to understand how others do it, so you can apply things at your own level. So right now I'm going to talk about two strategies. I have already talked about one of them previously in another video. I will have a link in the description. This is called, I call it the turtle strategy. This is a very slow strategy that really doesn't care about the direction. It involves having two orders placed, one at the top of a range and one at the bottom of a range, with of course some margin of error. So let's say we have a range limit at 50k and the range limit at 40k. We will add a margin of error of $500 to $1,000 in order to trigger our trades. So basically, like you see on the screen, we are taking two directions. We are not biased to a bullish momentum or a bearish momentum. We have our orders placed and we are waiting. Now this turtle strategy works best on the 4-hour time frame, and it can be applied also on the daily, but with slightly lesser results. This is the first type of turtle strategy. Now let's get to the second one. Now the second one is also a turtle strategy, but it also involves some hedging. So basically you will have a range and you will enter a long at the top of the range, you will enter a short at the lower part of the range, but you will have a continuous circuit that will run basically forever. Now let's say that the price will reach the top part of your range. You will enter your trade as a long, but the price will revert. Now you will have another order that will have a multiplier applied on it. So let's say you entered with 1, you will have 1.7x as an amount on the short entry at the bottom part that will complete the circuit. And this circuit will go on, it can go on for 5 or 6 times before it reaches either a long profit or a short profit. Now we have a complete description of this strategy in our Google Drive. It is a very complex strategy, so I will not take your time by explaining it right now. I invite you to check the drive out, the Sublime Traders Drive, where the strategy is explained in detail. And lastly, the strategy that you might already know, it is called grid trading. It has become popular when Binance added their own grid bot. Well, it's not a bot, it's just a scheme of trading on their platform. Grid trading for me is like the poor man's market making strategy. it can work. However, it is extremely risky if you do not protect it. The ways you can do it is you can trade it on futures with a high risk, high reward, profit potential, or you can trade it on spot. Now this is where it gets interesting, because Binance doesn't propose grid trading on spot, because, well, you don't get liquidations, they don't get money, it is not profitable for them. So they didn't get bothered to add spot pairs to grid trading. However, you can use grid trading on bots like 3 commas. There are some open source solutions in Python that also allow you to create grid trading strategies on Binance or any other exchange that can be profitable if they are managed correctly. So for example, on 3 commas, if you take the last grid trade that I have posted, it is a pair with BTC, so it is a spot trade, no leverage. It has a moderate to low volatility in the market right now. It is not extremely profitable as a futures grid would be. However, the risk is very low. Why? Well, let me explain. So what happens when CND with BTC goes up and you are inside your grid? Well, you will have your sell orders, you will have your buy orders, and you will be profitable. However, if you go outside of the grid, you will not lose. This is a good part of trading grid bots in spot, because, well, for one, you have time. Let's say you trade an USDT pair and it goes very high or very low out of your range. Now, if you were to do it on futures, you would most probably be either liquidated or at a huge loss. Now on spot, for the first part, you are not using leverage, so you are calmed down. And for the second part, if it goes down out of the range on the lower part, you can either wait, or if you are really desperate, you can sell, but you have more options. If the price goes up outside of the range with the BTC pair, for example, it means that the underlying asset, so the primary asset, in this case CND, has gained value. So what you can do is you can rebalance the strategy. You can sell CND USDT and buy back in BTC and rebalance everything and restart with the potential new channel, because of course grid trading strategies work best in sideways markets. If you identify a very good sideways market, it can be extremely profitable. So this is all for today, guys. We have talked about 5 market neutral strategies that you can apply at your own level. This is all for today. Thank you for watching. I am Logical Orange for Sublime Traders. See you on the next one.